Markets are an auction process, okay? And we could take anything that can be traded with buyers and sellers that negotiate a price, which is what financial markets do, and we could apply this. So what I'm going to do is walk you through an example to help simplify this in your mind. Some of you have heard this before with the intro course that I did. And we're going to say, let's say that we have all the sales data and all the bid-ask data, everything on Honda Accord sales in the United States. What we have is a car that's worth $22,000. Okay? So we know that buyers are motivated to get a great deal and buy lower. You walk onto a dealership, you know there's some negotiation that can take place, at least here in the States, that's how it's done. And the dealerships themselves are trying to sell it for as much as they can. No different than a share of Apple stock, no different than a contract of S&P 500 futures. The sellers want to get the most they can for it, the buyers want to pay the least they can for it. Okay? So what happens is that a market will generate an area where buyers and sellers, and in this case it's a simple example because we can look up all this information about cars, we kind of know what their general value is, and this will tend to trade around $22,000. Okay? Now, what happens, what is the dynamic when price goes up to $23,000, $24,000, $25,000? Okay? Yeah, sure, absolutely. Anytime you guys want to say anything, please feel free. Yeah, more specifically, what is it?
Buyers are told to people to bid it up, pay up for it.
Sellers will get inside the market and the price goes down.
Yep. So buyers and sellers, let's look at both. Buyers become more and more reluctant to pay those higher prices. So the aggressiveness, the amount of volume, the amount of cars being transacted that buyers are willing to pay at those higher prices become less and less. That demand dries up. Aggressiveness from sellers is at an all-time high. They want to move as many, those dealerships are like, wow, people are paying 25, this thing's only worth 22. Let's sell as many as we can at this price. So they're very aggressive selling. The combination, I don't care if we're talking about tape reading or whatever it is, the combination of less and less aggressive buyers with more aggressive sellers, we revert back to what we're going to eventually define as value, okay? So that's what happens there. We trade around. Let's say that we got some people, some dealerships offering some incentives. We trade lower and lower. The opposite happens there. You already know what the answer is. It is dealerships are like, whoa, my margins are getting squeezed. I'm not making any money. I may be losing $1,000 by selling this car. And buyers are like, call your parents, call your sister, call your wife. Let's buy as many of these we can. We could go sell them for 22 somewhere else and make money on this, right? This is an auction process. So you have the sellers are saying, ooh, not as aggressive, not wanting to move as much here, and the buyers getting very, very aggressive. So again, we revert back into this in this area. And so what we end up with is kind of a normal distribution of prices traded, right? If we were to plot all of these transactions that we've just walked through, it would end up looking something like this. Right? And what we would call a normal distribution. And we'll talk more about that in a little bit. But this is representative of a market that has established value, okay? And that is the dynamic that occurs in stocks, in futures, in everything as we trade higher or lower. So as we begin to continue to study this in auction market theory and market profile, value becomes a key component. Rather than just looking at where price is and getting so sucked into price all the time, we can observe where price is relative to value, okay? Now, this dynamic doesn't exist forever in markets, right? They don't just go into one area and it's always, if it goes up a little bit, we can short it and make money. If it goes down a little bit, right? That doesn't exist. Why? Because it's complex. It's very, very complex. It's not just like a single car and a very simple type of analogy like this. It's very complex, various time frame participants, people with different incentives. It's very complex, but this stuff still applies. Now, what happens when we get some new information? Okay, let's say that the wheels are falling off Honda Accords. It's bad news. It takes about $10,000 to fix that and have it be a perfectly brand new Honda Accord. What's going to happen to price? It's going to go down. Price is going to form a downtrend until we can find a new area and establish a new value. Price is seeking to find value, okay? So it'll come down. Let's see, I think I can do this. Let's just make this small. There we go. Okay. And then what happens is people say, oh, you can fix it for 10 grand. And we get down here to 12. And people start to say, oh, I can buy this for 9 or 8, put 10 into it and make a couple grand profit, right, after I sell it. So they start to buy it and there forms some demand and blah, blah, blah. And then you end up with some suckers paying too much where they have to fix it and they end up, having a car that they've put too much into and it's worth that. So this market condition, if you will, which we'll talk a lot about, begins to repeat right here. We got a new area of value. Now, even new information comes into this market. The wheels, this is a simple example. The wheels just aren't broken anymore. The ones coming off, it's like, wow, these are great again. What's going to happen? Price goes up, obviously, but tell me something more specific. Where's price going to go?
22.
Use a different term.
The former value area.
Yes, price. From the guy that says he uses it every day, showing his worth in here. We revert to a prior area of established value. This is what markets do, whether it's a simple car example or it's complex financial instruments. This is what unfolds. So we've gone through this. I knew what was coming. We have car sales, we have trading, we have value. What happens higher, what happens lower, that supply-demand dynamic. The drying up of certain participants, the more aggressiveness of certain participants. Hint, hint, order flow tools we can use in the future at these key areas. All right, so here's an actual market profile example. Each one of these represents a day, okay? And we probably had an area of established balance higher. We got imbalance to the downside, okay? It's new bearish information, and then what happens? New value starts to get established and we start to form a range there. This cycle of balance to imbalance to balance to imbalance to balance repeats all the time on various time frames all over the place. But that is the cycle that continues to repeat.